Okay, we saved the best for last, so we got some IRS tax updates. I don't think much has changed, but I have no idea. In my mind, nothing's changed. So I got Lauren Carnes and Ryan McDonell from my office coming up to present that.
Excuse me, still a little bit of a cold. Yeah, like Kevin said, some of the most interesting stuff for last, tax update. I'm going to present here briefly on some of the federal tax changes, mostly on if everybody's been hearing about you can take bonus depreciation for dealerships now, which is great. So I get to actually deliver some good news on tax. And then Lauren's going to come up on sales tax, cash reporting, and IRS audits. So the depreciation regulations, it's kind of weird, but the final version of the regulations, as well as an additional set of proposed regulations, came out in September. I believe it was just about a day before the extension filing deadline. So it didn't really leave much time for anybody to scramble there. But one of the big takeaways from those depreciation regulations is that dealerships are now eligible for bonus depreciation in certain circumstances. I'll elaborate on that, but that means that dealerships can immediately take the deduction for a lot of, if you think like equipment purchases. Businesses leasing property to dealerships, if you have the building held in a separate LLC being rented to the dealership, that is eligible for bonus depreciation. And qualified improvement property, which is, think non-structural changes to the inside of your dealership, maybe like partitions or any type of changes that are non-structural inside. Those were supposed to get an advantageous depreciation life, and you were supposed to be able to expense those immediately. Because of a hiccup in the actual writing of the legislation back in last year's tax law, it's stuck at 39 years and you can't expense it. So the big thing here again is that bonus depreciation is available for dealerships. Bonus depreciation in previous years, it allowed you to immediately expense half the cost of certain assets you purchased. With the tax law change, they made it 100% expense, so you didn't have to recover the cost over several years, 5, 7, 15, you could take it right away. And they also expanded it so that you could take it on new and used purchases, not just restricted to new purchases. So that was great news. However, along with that, the tax reform also created an interest expense limitation. So we, of course, think of like floor plan interest expense, but if you're paying any other interest expense on loans, for example, anything like that, there was a threshold set so that basically you couldn't deduct interest expense that exceeded 30% of your net income for the year. Now, with that, they did say because floor plan interest specific to the auto dealer industry, it's a prominent expense, it was allowed that you could deduct this floor plan interest regardless of this limitation. So even if your interest was much higher than 30%, you could still fully deduct it. In exchange for that, they took away bonus depreciation for dealerships. And because of the way that it was originally written, because of the lack of guidance on it, it seemed like if you were a dealership and if you had floor plan interest, which would, qualify almost everyone, if not all, then you would lose the ability to immediately expense your assets. However, NATO went back and commented along with others, and they said, that makes sense as far as on a trade-off perspective. If you're taking excess interest deductions on your floor plan, fine, there's a trade-off, you can't take bonus depreciation. But what about those dealerships where even if it wasn't floor plan, even if it was just regular interest you were paying on other expenses, we aren't even getting the benefit of that. It's well under 30%. We're getting hit twice. We don't get the benefit of this new interest rule, and we don't get to expense our assets right away. So in this latest set of regulations, they came back and said, if your total interest expense, including the floor plan, is under 30% of your net income adjusted, then you can take bonus depreciation. meaning if you're not really getting any special treatment because you have floor plan interest, if the only reason you're fully deducting all of your interest expense is because it's a low amount, then you're not getting any added benefit on the interest expense side. So because of that, you're going to be allowed to take bonus. It's on an annual determination. One of the bad sides to it is that there's no real threshold. The way that it's written, it looks like the second you're taking an extra $1 of interest expense deduction because of this, you immediately lose your availability to take bonus. So that's why when we might be out there doing some tax planning, seeing where everything is towards the year end, it's really important to try to land and see where that taxable income figure is going to be, because that could swing whether or not you're going to be able to expense all of your purchases for the year. As an example on this, just using simple numbers, so say for example you had taxable income of $100,000 for the year after you take all of your income and expenses. 30% of that is $30,000. So in the first scenario, your total interest expense, a mix of debt interest, floor plan interest, everything, comes out to $25,000. This is less than 30% of your taxable income, so you're not getting any special treatment because you have floor plan, and for that reason, you can take bonus depreciation in that year. However, in scenario 2, say you have $35,000 of interest, let's say $7,000 of interest, or let's say $20,000 of interest is floor plan in this one. You would normally have been limited to taking $5,000 of that interest you wouldn't have been able to take. It would have gotten carried over to the next year. But because you had floor plan, you get that special treatment and you get to deduct all of it. In exchange, you would lose your ability to take bonus depreciation, and all those asset purchases, all the equipment and everything that you would have otherwise been able to expense directly that year, now you have to recover that over 5 years, 7 years, etc. So it is something where, again, looking at that taxable income figure towards the end of the year, seeing if we can gauge whether or not you'll be able to take that bonus depreciation expense. And before getting the 20% as well. Okay. No, so those are still also subject to the same, as long as, whether it's an LLC or an S Corp, if you're getting that benefit because it's floor plan interest, that's kind of the key. If you're getting that deduction because it's floor plan interest, that's where you lose bonus depreciation. The structure, whether it be an S Corp or an LLC, that kind of changes the way that, if you do lose any interest, it changes the way that all flows and everything. But in the context of bonus depreciation, it doesn't impact it that way, no. Say that again, I'm sorry?
So even if the underlying partners are trusts, that doesn't impact the ability to take bonus depreciation? I thought it did.
Well, yes, because certain trusts aren't able to take bonus depreciation at the trust level. What this is here, though, is more so, this is an entity level determination. So while you may have some partners in an LLC that would prohibit you from being able to take bonus depreciation when it gets passed down to the partners, that's definitely still possible. Nothing has changed on that side. This is more of an entity level change. And kind of with this too as well, when you do make that determination of looking at your floor plan versus your 30%, you're looking at gross floor plan interests. There's no official IRS determination on this, but when we had reached out to NADA, they kind of threw back, almost like a common sense way of looking at it as your floor plan expense and the floor plan assistance. You shouldn't be able to net those in making this determination because you're looking at one from, a manufacturer versus a lender, for example. So even if considering floor plan assistance income that you may be getting, maybe that wipes out your floor plan interest expense, you have to look at that on a gross expense basis. And then just touching quickly on There was a lot of talk about the 20% deduction coming into this past season. It allows you to take deduction of up to 20% against the income that flows through on your K-1, for example. When you hit certain thresholds, you're limited to the deduction based on how much wages the entity pays or how much property is in the dealership. If you didn't already do so during the last year's tax filing, you just want to look to see there's an option to aggregate or basically combine. So if you have your property held in a certain separate LLC from the dealership, you can combine both of those to maximize your deduction. And similarly, if you're getting retro warranty, sometimes you hear it called kickback, anything like that. If you're able to run that through the dealership, that income would also be available for the 20% deduction. Any question on those areas of the tax law? All right, thank you.
Okay. All right, it's my turn. I'm a horrendous public speaker, but I'm going to give it my best shot. So I thought it would be important just to give you an update on what's going on in like the IRS sales and use tax and some cash reporting. We've seen a lot of activity in sales and use tax audits. Have a flurry of audits going on, and I thought it would be important just to give you an update of what goes on in an audit in a little bit of detail, not just the overview, what they're looking at, and maybe some pointers on what you could look at your dealership. So these are the big points. They look at all the fixed assets during the audit period. They look at all the expenses for a test period. The agent would look at a test period of sales invoices, ROs, and extrapolate the findings. The ST4s that you have on file, and reconcile the sales and use tax filings to your tax returns. I think it's important to note that a couple of key points. The fixed assets, usually that would be if you buy anything out of state, especially mass dealers. I know we have some that aren't, but mass dealers, if you buy something out of state, you should kind of take a look at that. Did they charge sales tax? If they didn't charge it, you should pay use tax on it in your next filed sales and use tax return. Expenses, especially, someone should start to take a look at your expense, like your AP invoices. A big area that I've had a lot of issues with is software, cloud-based software, that kind of stuff that you can manipulate the software, dealer track, items that you wouldn't even think, F&I, lead software, those kind of things that you can take and manipulate that you'd be surprised that the DOR is looking for sales and use tax on that. And then the ROs and the sales and the expenses, policy work, and those kind of things that you would be surprised, like, oil changes and those kind of free things that you give. If you're not charging sales and use tax on the filter and those kind of things, you have to be sure that, because you're doing a favor for somebody, you have to be sure that sales and use tax gets applied and paid. And then ST4s. You would be surprised how old those ST4s are and how many we don't have when the agent asks for them. They give you 60 days to come up with them, but it would be worth a good exercise when you go to do your January payables, or to have the parts person go through them and kind of get them updated so that you are a little bit ahead of the game. So when an agent comes out, this is what their request looks like. They're looking for a chart of accounts, the AP and the voucher payable purchase journal to kind of see where you're getting your stuff from, our work papers, schedule of operating expenses, AP invoices, leases, resale and exempt certificates, detailed depreciation schedule, and copy of the sales and use tax filings. And they'll usually come in, they do an opening conference, They go over what the test period's going to be. They come up with a plan. They're there 2 or 3 days. They come up with a proposed assessment, and then they would come back and have a little closing conference. A couple of areas that I thought of is rental car, enterprise rental car, or wherever you're renting a car. Those are subject to sales and use tax return also. Leases, I meant more like enterprise, not leases that you do. And that's kind of their MO. Questions? I know I did that fast. Yes? But are you paying the use tax on a monthly basis? Because then you're all set. Yeah. So, anybody else? Okay. All right, so now we're going to go on to a different topic of sales and use tax. Everybody is familiar or have heard this whole thing of the Wayfair case decision. So, different from sales and use tax is the whole idea of how to collect sales and use, out-of-state purchases, out-of-state sales. Historically, the state could not collect if you didn't have a physical presence. We all know this. We all bought on Amazon. Nobody charged us sales tax, and it was kind of great. Now, 2018, there's this big decision, South Dakota versus Wayfair, and everybody's charging sales tax. And it is an issue. States, I don't think, have come up with a way to kind of apply this or to audit it, but I can imagine somehow it's going to come because they have now come up with a whole new set of laws, and that it's not an income tax, and they're not requiring us to pay income tax, but they now require businesses to collect and remit sales tax even without a physical presence. Every state has like a different rule as to the amount of sales, the number of sales. They have different thresholds based on all sorts of elaborate rules. It's not like one set. If you sell parts over the internet, or you sell a grand amount of parts, like that's a big part of your business, and you're not collecting and remitting sales tax, you should kind of contact us, because there's all sorts, you should be paying and remitting sales tax when you sell those parts. Most states are moving toward an economic nexus system, and it's a certain amount of stays, and a certain amount of sales, and a certain amount of transactions. In New England, Massachusetts, it's 100,000. Connecticut, Maine, Vermont, it's 100,000 of sales or 200 sale transactions. So try to pay attention. I mean, that's ridiculous, trying to pay attention to how many, is it 200? Did you sell 100? And then you'd have to register in the state, you have to collect, you have to remit. It's like a record-keeping nightmare. So this is best practices, is to record the sale revenues from each state, keep a record of the amount, and if your business has more than 100 or 200 with any state, you almost have to consider paying and remitting to those states. Because otherwise, somehow, the various states are going to find you. California, New York, Rhode Island, Vermont and Maine, and they're not yet, but some of these states have already started to send out questionnaires to various businesses. Do you sell? And they're looking for their pound of flesh because everybody's desperate for money. Questions? Okay. All right, cash reporting. I have seen a flurry of these. I don't know if anyone's been audited. For a while, there was nobody. And then I've seen a ton in Vermont, in New Hampshire, the same agent going around and auditing and doing some cash reporting auditing. The penalty for cash reporting is $50, $100, and then if they think it's intentional, it could be up to $250,000, $25,000. I think it's important that are you cash reporting compliant? Do you properly report all of them, randomly test them, properly complete them and submit them to the IRS within 15 days and then to the payer on the 31st of each year? Did you institute the proper accounting procedures and controls that within the IRS's guidelines? Do you do staff training and education on a yearly basis or maybe every other year? Do you understand, or your staff understands, what's a cash equivalent? Do they know what a related transaction is or suspicious? Sometimes I tell clients, do a test every other year or every 6 months, or somebody look, because the minute they get that notice from somebody, everybody's in a panic, and I say, well, go back and test what's going on and test to be sure that your procedures are in place. If you do get a penalty, or they do fine, sometimes it's better if when they show up, you say, here, I found 2, or this is what I found. If you have this in place, or if you've done training or education, they'll waive that penalty. If you have none of this in place, it's hard to get the penalty waived. All right, and questions on this at all? All right, last but not least, I just thought it would be important to talk about IRS audits. There used to be a lot. That used to be something that used to happen. It's much more infrequent now that the government has shut down and doesn't have as many staff people as they do. Their level of audits and level of agents is much less than it has been. Usually someone gets audited, corporations, because of either something called the DIF score, market segment specialization. There used to be a whole automobile dealer specialization group that used to go around and audit, like for certain issues. Random, business activity code, a tip, or sometimes tax returns with prior audit history. So if you got audited 1 year, sometimes they wait 2 years and then they come back. Here's the areas that we always see: shareholder loans, receivables, payables, negative AAA, documentation, interest, adjusting entries, intercompany accounts, basis and schedules and support. My most favorite is personal, planes, boats, business. That's my favorite. Various elections that aren't on the return, and M1s. So, and their IRS has been quieter than it has been in the past. And I think that's the end of that. Yes. That's the your adjustment account on the tax return. If you take a distribution against it, sometimes they look at that. Did you have a loss and you took a loss on your return and you had negative AAA, the tax term. Of course, Linda. You looking for that? Yes. You're welcome. Anybody else after that?
I'd like to thank everyone for coming, and thanks all the speakers for presenting and the lunch and everything like that. I really appreciate it. I hope you guys got something out of it. If you didn't, well, you got what you paid for. So, but thanks a lot. I really do appreciate it.